He's been bullish on the energy sector. It's good to see you, Dan. Welcome. And I think the last time we had a conversation, which was maybe less than a week ago, you suggested that you hadn't done anything to your energy holdings. Now what?
Yeah, I mean, listen, our view is structural in nature, not favoring it versus other sectors in the market, let's say. And then the views that we hold are not particularly out of consensus at this point, although they might have been when we sort of started taking a look at the sector. And it was really predicated on the low levels of inventories, which remain in place today, the reduced CapEx budgets on the part of the majors and the miners, and the investor pressure against doing sort of CapEx that exceeds your cash flow. And that nothing has more or less changed on that front. Even if you wanted to drill more right now, you've got expensive labor. You've got first of all, you've got to find the labor, and if you do, it's expensive. The materials are more expensive, and the overriding ESG theme is really what started this whole conversation for a lot of investors, such as ourselves, in the sense that traditional investors were just shying away from the space, which opened up valuation dislocations, and that ESG focus, if you will, or lack of focus on the space, also remains in place today. So, listen, it was a bad week. There's no doubt about it, but those structural factors are in play and probably provide support to the commodity beyond what might normally be expected in this type of environment.
Well, see, that's an interesting point you make because, and I know this is going to sound controversial, and it's not me making this point, but there's a gentleman by the name of Tom Fitzpatrick over at Citi who put forth a thought today that his headline of a note is oil about to spoil the narrative in the short term. He is talking about WTI going down to 86 to 93, and that would be about, changing the short-term landscape potential of the market. I'm wondering, I guess that would lead me to ask you, how tied to the overall market performance is elevated oil? And if oil does have a sizable pullback, does that open the doors for a broader rally in stocks?
Yes. So I'd answer that two ways. First, with respect to the sector, I think our view is that oil can come down and the equities and the credits don't necessarily need to see a similar decline, if you will. For starters, a lot of the names are not incorporating oil at current levels. You've got the geopolitical risk premium and another number of other things at play. So even if you fell, as we have, it doesn't actually imply, although that's what's happening, that all the equities need to come down and the credits need to widen out. So in a structural sense, we still believe that. But for the broader market, I think you hit the nail on the head. And I think in your conversation just now with Jim Lebenthal, you're talking about what are the types of things that the market needs to see. And as a starting point, the answer is lower gasoline prices and lower oil prices. Because if you're looking for the Fed to give you anything resembling a white flag, you're not doing anything until some of these commodities start coming down. Because for the average person on the street, inflation, quote unquote, is gasoline at the pump and commodities and food at the supermarket. And so you've got to start seeing some relief on that front before the Fed can do anything really in terms of taking its foot off the brake.
So you were with me just prior to the CPI print a week ago when you suggested that stocks could bounce up to mid 4,000s, what you said. Obviously, the CPI upset all of that. The question is, when you look at the market now, post-Fed, how does it set up for the next week or so?
Yeah, I don't know about the next week. And my point about the mid 4,000s was that's traditionally the type of bear market rallies that you have. They go up, call it 10%, maybe 12%, and that would have put you in that level. But obviously the CPI number, which came out shortly thereafter, as you said, spoiled the party. In a larger sense, you and I have been talking about this for quite some time. Investors need to deal with the reality that the Fed put is dead, so to speak, and that's not unimportant considering its importance over the last 15 years. And the overwhelming likely outcome of what they're doing is going to be negative for risk assets, and probably more so. That said, you've done a lot of the work already, and I think you talked about this in the last segment as well. The multiple's down 40% or something. Obviously, we haven't seen earnings come down, but a 40% drop in your forward earnings multiple for the market as a whole is a very substantial decline. That goes a long way to correcting some of the excesses that occurred in the post-COVID environment. Earnings are going to come down. We know that. Energy, they have already started to do so, at least for this year. But that multiple drop gives you some cushion going forward to think about what the potential downside is from here.
Is this all about, and lastly, too late and too much from the Fed? They waited too long, and now they're going to do too much?
I mean, they have made several mistakes. I'm not alone in that belief. I think even at the time, let alone in retrospect, you knew there was mistakes being made. And again, these are human beings doing their best. But the odds that they thread this needle just remain exceedingly low. I wish them the best. But as investors, you have to plan for the likely outcomes, what's your expected value. And your expected value is that this is just not going to end well. And that's what you see in risk assets already.
Yeah. Good weekend to you. Happy Father's Day as well. It's Dan Greenhaus. We'll see you soon.